Hey, what's going on, everybody? On today's video, we're going to be talking about a very important subject, which is how to access credit or how to access capital for small business owner. Very, very important, especially if you're a small business owner. Every business owner wants to access credit. They want to access capital. They want to get some funding, some loans to start their business, but they just don't know how to get it. So that's what we're going to be talking about. And we're also going to be looking at some of the most common financial product or lending, borrowing product that are out there that small businesses are not aware of that they can actually tap into. All right, so let's get into the presentation. So we're looking at the most common financial product when it comes to small business in terms of lending and accessing credit, because every business wants to know how to get some credit, some funding, and that's what I'm going to be covering in this video, how to get it and what is the procedure. And you got to know some terminology, some languages that you have to be very well you have to be knowledgeable, so that way when you sit down with your banker, your financial advisor, or your the loan officer, got to be able to speak their language. Okay, so let's get into the presentation. So when it comes to accessing capital, the first thing you got to do is this, right? If you're a small business owner, well, you got to be registered, right? So let's say if you're new, right, you got to be registered. So you got to set up your business structure. So you're either going to go with a sole proprietorship, partnership, or you're going to go with a corporation, right? So very important. That's the first thing. You got to be registered. If you're not registered, if you're not registered, or if your business is not registered, you're not going to get any capital. You're not going to get any funding. Matter of fact, if you're not registered, don't even bother asking for funding. Don't even go to the banks asking for capital, asking for money, or asking for loan, because you're not going to get it because your business is not registered. So make sure you register your business first, right? So either sole proprietorship, partnership, or corporation. That's very important. And then secondly, right, you got to know your credit profile group in terms of where you stand in terms of credit. Because here's the thing. All lending decision when it comes to business funding is all based on your personal credit. Don't be surprised by that. Don't let anybody fool you. It's all based on your personal credit, right? If you want to get a business loan, if you want to get business credit, if you want to get business funding, it's all based on your personal credit. Especially if you're a new business, you got no cash flow, you have no inventory, you have no sales, you have no customers, you just have a concept. It's all going to be based on your personal credit. So your personal credit plays a critical role in you getting funding. So that's why you have to know exactly where you fit in. Now, there's 4 different categories. So most likely, every one of you, everybody that's watching, they all fall in within these 4 categories, right? So the first category is no credit history. So basically, no credit history means that you have no credit, right? You're not in a credit profile, in a credit system, Equifax and TransUnion. You don't have any data. You don't have any credit products. So you basically are what we call, or in the industry, they call them credit invisible. So these are individuals that have no credit history. So if you want to get some funding from the banks, if you want to get some loans, if you're starting a business, you got to have credit, right? You have to have credit. You have to establish credit. You have to be in a credit system. So in this case, right, everybody, you fall within one of these groups. So either you have no credit, so you have no credit history, you're not in a credit system. You have limited credit history. What does that mean? So limited credit history means that you've had credit in the past, but you stopped using credit. So you might have had a credit card in the past that you closed, and then you haven't had credit, or you haven't used credit, let's say, in 5 to 10 years. So basically, your credit profile is showing that you had credit 5 years ago, but since then you haven't used it. So no credit history, right? So you gotta, you gotta have some credit. You have to have an active account on the credit bureau, so TransUnion, Equifax, in order for you to get some credit, right? So, and then poor credit history means that you just have poor credit history. You have too many negative items showing on your credit report: late payments, collection account, charge-off. Delinquency, 90 days late, 60 days late. So you just have too many negative items showing on your credit report. So that's poor credit history. And then you're either established credit, you have an established credit history. So those are the 4 categories of credit profile. So you either fit into one of these. So either you have no credit, right? You have no credit history, or you have limited credit, or you have poor credit, or you are an established pro, so you've had credit in a while. So now this is what you need to know. If you don't have any credit, so if you have no credit history, then you gotta get you some credit. You gotta either get you a secured credit card, which is the easiest to get, so you can generate some credit in the credit system, so that way you can have some data, because that's what banks are looking for. They're looking for data. Now, you want to keep this in mind. Very important that you know this, that most banks, they will prefer that you have at least 24 months of credit history before they can extend you any funding, any credit, any business loan, or anything like that. So you got to have at least a minimum of 24 months of credit history. What does that mean? It means that for 2 years you've been using credit, so you've been using it, paying it off, using it and paying it off. So you've been active in the credit system because you've been using credit. So that's what most banks, they want to see you at least, that you have at least 24 months of active credit history data, right? Because it's all about data. They want to see your payment history, how you've made payments in the past. Because remember, you're borrowing money, right? You're going to the bank, you want to borrow 20,000, you want to borrow 10,000. But if you don't have any credit history, then that means how are the banks going to know that? How are they going to know your payment history? How are they going to know? Because you have to put you got to think like a lender, right? If a lender is going to lend you money, they want to know, okay, what is your payment history? How have you paid back your loans or or any other borrowing product that you've had in the past? So that's what they're looking for. They're looking for a 24 months of credit history. So you want to keep that in mind. You want to have a minimum of 24 months in credit history or credit data in the system. So Equifax and TransUnion, okay? And then people that have limited credit history, then that means, right, you got to get back to credit. You got to go get you an unsecured credit card, right? Talk to your financial institution, your bank, so they can get you an unsecured credit card so you can start generating data again in the credit system. Because remember, right, we're talking about, how to access credit, for businesses. So small business financing credit products. So you got to have some credit history, right? You got to start using credit again if you have limited credit history. And then if you have poor credit history, then you got to start fixing credit. You got to start looking at your credit report, see what's there, and start cleaning up your credit report so you can get some of this funding, because the funding is there. There's some capital. There's a lot of funding that's available, but it's all based on your credit history, okay? So now we're going to take a look at some of these financial products that are most common to small businesses that you can apply for. So let's take a look at, business credit card. Business credit card is very common, right? Because that's the easiest to get. It's very easy to get a business credit card, especially if you're starting out. So let's take a look at some of the benefit of a business credit card, right? So let's see here. So now, usually with a business credit card, as I mentioned, it's very easy to get, right? It's very, very easy to get. It doesn't take a lot, right? There's no let's look at a benefit of a business credit card. Now, a business credit card is what you call a revolving credit, right? So revolving credit means that, right, you use what you need. So if you have a $5,000 business credit card, especially if there's no fee on it. So let's say you use $1,000, then your available balance or your available credit will be $4,000, right? And you have a balance of $1,000. So it's revolving. So that means that whatever you use, you can pay it back and just continue using it. Use it and pay it back and continue using it. So those are business credit card, as I mentioned, is very easy to get. It's the most common type of credit that's available for business owners, okay? So let's look at another product here. Credit lines, right? Now, a credit line, what it is that it's a combination of a credit card and a line of credit. So that's what a credit card, a credit line is, right? So a credit line is a combination of a credit card and a line of credit. What does that mean? So basically, if you're a small business owner, you have to know the term cash advance, right? A cash advance is when you take cash from your credit card. Now, usually with cash advance, the interest rate is high. So, if you're a small business owner, or if you even have a credit card, you want to stay away from cash advance, right? Now, there's different types of cash advance. One of them, which I mentioned, is you take cash from your credit card. So you go to the ATM machine, you insert your credit card, and you pull out cash. So that's what you call a cash advance. The interest rate is really, really high on a cash advance. And then there's also what you call a balance transfer, when you're paying off a high interest credit card with a credit card that has a low interest on it. So that's what you call a balance transfer, and an access check when you write checks again. So those are the different types of cash advance, but you want to stay away from cash advance. Now, one of the benefit of a credit line is that it's a combination of a credit card and a line of credit. So which means you have that flexibility of using a credit line, as a credit card. So you can use it for online purchases, but at the same time, you can also use it as a credit line. Right now, with the credit line, now with cash advance, remember, with cash advance, there's high fees, and then there's interest rate is high, and then there's other fees. Now, usually with credit line, because it's a combination of a credit card and a credit line, right? Sometimes the fees are not included in there. It's just a question of you talking with your financial institution or your bank to see, hey, is there any fees if I take out money from this credit card? So that's what you call a credit line. It's a combination of a credit card and a line of credit, right? So, you can use that credit line as a credit card because they will send you an actual card, a plastic card. You can use it to buy stuff online. You can use it to swipe, but you can also take money out of it without them charging you, fees and different types of, and the interest rate is usually low on the credit line as well. Okay, so that's what you call a credit line. Now, you also have term loans, right? Now, term loans, that's the most popular financial product for small businesses. Businesses love, a lot of small businesses love term loan, right? Now, the difference, what is a term loan? A term loan is basically, right, you're given a cash upfront, right? So let's say you get approved for a $30,000 term loan. So there's a loan, there's a term on that loan. So you have 3 years or 5 years to pay it off. Usually the interest rate is much lower on the term loan, and you make monthly payments on that term loan, right? So that's what you call a term loan, right? And then there is lines of credit, okay? So a line of credit it's a cash account, right? So the banks, it's also revolving credit as well, and it's the interest rate is usually lower, right? So those are some of the benefits for these products. So for a credit line. So credit line, the interest is lower and it's revolving credit. So it works in the same way as a credit card. But it's cash, right? It's a cash account, so you can take cash out at any time. There's no cash advance fee. There's no any other fee, right? So, and there is no, depending on the financial institution, some lines of credit is a monthly fee, some don't have any monthly fee. But it's, it allows you to take cash from your credit product without being charged any cash advance fee. So you got to understand those terminology. You got to understand what a cash advance is for small businesses. Those are the type of conversation you're going to be having with your financial institution. So those are the most common, small business financing credit product that are out there. Business credit card, credit lines, term loans, and line of credit, right? So you got to know the difference between all these types of credit product. Now, most of the time, a lot of small businesses are only aware of term loans and business credit card, but there's also, as I mentioned, there's business credit card, there's credit lines, term loans, and line of credit. Remember, a credit line is it's a credit card and a line of credit combined. That's what a credit line is, okay? And then you have your term loans, which is, you have 5 years to pay it off, and then you have your line of credit. So those are what you call those are some of the most common financial product that are available for small businesses out there. So you want to know this so that way you can take advantage of it, so that way you can use them wisely. Now let's get to the conversation of understanding what financial product actually fits you, right? So now when it comes to lending, right, you have to understand this. You have to understand there is what you call a secured funding and unsecured funding, or secured credit and unsecured credit. Now, what is a secured credit? A secured credit is usually when the lender will ask you to put in some sort of collateral, right? They will ask you for security, right? And it depends on the amount. Usually if it's over $50,000, so you got to remember that if you're applying for any financial product, right? So if you're applying for any of these products here, business credit cards, lines of credit, term loans, or credit lines and so on. So if the amount is over $50,000, most likely the lender is going to ask you to put in some sort of security, to put in some sort of collateral. So you got to remember that there's going to be collateral involved in it. Not only is it going to be collateral, but the lender is also going to ask you to provide full documentation, right? So security deposit, because you're applying for, right? Because some lenders have a cap in terms of how much you can apply for. So for example, an unsecured funding or unsecured lending is when it's the amount, or the bank or the financial institution, they're not going to ask you for any collateral, they're not going to ask you for any security. So that's what you call unsecured. It's unsecured. The bank is not going to use your house as a security, they're not going to use your car, they're not going to ask you to put any security, or they're not going to ask you to put any collateral. So that's an unsecured funding. So you have to understand these languages, right? These terminology. So that way when you're sitting down with your financial advisor, with your small business advisor, when they're telling you, hey, do you want a secured loan or do you want an unsecured loan? So you have to understand, what does that mean? A secured loan is when you're applying for an amount that is over $50,000. Now, some financial institution, $50,000 is usually the cap. So if you go over that $50,000, it turns into a secure loan or a secure funding, where they're going to ask you to put in some sort of a collateral. So it could be your home, it could be your it could be your if you have some financial instruments, or let's say if you have a GIC, a guaranteed investment certificate, they might ask you to put in a security. So you're going to have to ask your lender. You're going to ask them, okay, what amount, what is the threshold in terms of what amount do you consider unsecured? What is the limit that I can apply for without having to provide any security? And the lender is going to tell you. So as I mentioned, unsecured loan is when the lender is not going to ask for any security, they're not going to ask for any collateral. So that's what you call unsecured. Now you also going to have to understand the terminology of full documentation. So when you're applying for funding that's over 50,000, right? The lender is going to ask for full documentation. They're going to ask for your tax return. They're going to ask for they want to see your account cash flow. They want to see your what do you call it? Your P&L, profit and loss statement. They want to see everything. That's what you call full doc. Right? Full doc means they want every documentation. They want your business plan. They want your marketing plan. They want your cash flow. They want the last 6 months, the last 12 months of account activity. So that's what you call full doc funding, right? It works the same way as if you're getting a mortgage, right? When you're getting a mortgage, they go full doc on you. They want to see every piece of document. They want to see everything from 2-3 years ago. They want to know your income. They want to know how much money you make. They want to know everything. So that's what you call full doc. So as a business owner, you have to remember that if you're applying for an amount that is over what the threshold is, so that's why you have to ask them what amount is, they'll tell you that, hey, if you're applying for, usually $50,000 is the threshold in terms of if you go over that $50,000, then it becomes a secured loan. Anything under 50 is unsecured, but once you go over 50, then it's secured, and they're going to ask for full documentation. They're going to ask for everything. I'm talking about your notice of assessment, your tax return, they're going to ask for all those documentation. So that's where a lot of small businesses actually run into trouble, because when they're asking for an amount that is over what the banks considered unsecured, so they might be asking for $80,000. So once you go over that, then that's when the lender is going to be asking you for all these documentation. So that's why you, as a small business owner, you got to know, you have to ask these questions. What is the limit? The unsecured limit funding that I can apply for without me having to provide full documentation. Because unsecured funding, you don't have to provide full documentation. That's what you call no doc funding. It's just based on your personal credit, and it's based on your basically it's just it's based on your personal credit and your stated income. So you have to understand that language, because if you're applying for the wrong type of product, right, whether it's secured or unsecured, right, you might run into a surprise where they're asking you for all these full docs. So remember that full doc is when the lender will require you to provide full documentation in regards to your business, how much money you're making, your tax return, cash flow, business plan, marketing plan. Now, full doc is usually when you're applying for an amount that is over $50,000. So when it's over $50,000, right, it becomes a secured loan. But if it's under $50,000, it's an unsecured funding, right? It's an unsecured loan. Then the lender's not really going to ask you for full documentation. There's some lenders, they won't even ask if the amount is less than $50,000. They won't even ask you for any documentation. So that's what you call a no-doc lending or no-doc funding. So you got to understand these is very important, because sometimes a lot of businesses, they run in trouble because they want to buy a truck, and this truck is, it's like $80,000. It's a food truck. They want to start their own food, their own restaurant or their own food business, and they want to buy some trucks, or they want to start a cleaning business, and the total amount of equipment is going to come up to, let's say, $65,000, and you want to get a loan or you want to get a financial product, and the bank ends up asking you for full documentation. So that's why you have to understand the difference between unsecured and secured funding. So that, hopefully you've understood this, so that way when you're applying for funding, you know the difference between unsecured and secured funding. So unsecured is when the lender is not going to require any documentation, and if the amount is less than $50,000 and it's all stated income. Secured funding is when you're applying for something for lending more than $50,000, and the lender is going to ask for full documentation. Okay, so that is pretty much it. And as I said, you got to know your credit profile, right? Because everything that I'm telling you, it's all based on your credit profile. It's based on your, all lending decision is all based on credit, right? How much money, basically how your credit is, right? So your credit is very important. So that's why you're going to want to take care of it. So that way, when it's time for you to get that funding, then, your credit is good. You won't run into these barriers where the lenders is asking you for full documentation because you're asking for an amount that is over their threshold, or it's over than what they usually cap it at. So hopefully you've learned something from this video. I want to keep it short, and I will continue to put out some more content, more information to help you out in your funding journey as a small business owner. Okay, so until then, I'm going to see you on the next video. Peace and blessings.